Soaring public debt. Before the COVID-19 pandemic, the U.S. federal debt ratio was already over 100% and sharply rose to 133% of GDP by the second quarter of 2020 due to increased spending from stimulus measures like the CARES Act and decreased tax revenues. The Federal Reserve's aggressive quantitative easing (QE) and near-zero interest rates helped absorb the surge in government bond issuance, preventing a crowding out effect and maintaining market stability. During this period, the U.S. dollar's status as a global reserve currency and the perception of U.S. Treasury bonds as safe assets facilitated the government's ability to expand its fiscal deficit while keeping interest rates low. Despite concerns about the long-term sustainability of high debt ratios, the U.S.'s strong political and economic systems, and international confidence in its ability to repay debt, contributed to the feasibility of these expansive fiscal measures. However, the Federal Reserve's extensive purchase of government bonds to finance the federal government's deficit blurred the traditional distinction between fiscal and monetary policy, leading to debates about fiscal dominance and the monetization of fiscal deficits. This situation raised questions about the central bank's independence and the long-term implications of a significantly expanded Federal Reserve balance sheet. As the Fed became the largest holder of government bonds in the U.S., concerns emerged about its future ability to manage liquidity and interest rates effectively without causing strain on government finances. The historical conflict between the Federal Reserve and the Treasury during World War II over interest rate fixation underscores the potential challenges ahead in maintaining the balance between supporting economic recovery and ensuring the Federal Reserve's independence and effective monetary policy. MMT. During the COVID-19 crisis, modern monetary theory, MMT, gained attention as a controversial macroeconomic approach advocating for aggressive fiscal policies and deficit monetization. MMT suggests that countries with reserve currencies, like the U.S., can essentially print money indefinitely without immediate repercussions, such as fund shortages. It views government deficits as private sector surpluses and considers real spending constraints to be based on available resources rather than fiscal deficits. According to MMT, taxes are used to manage demand and inflation, while the central bank's role is to support government spending, downplaying its independence. The massive scale of quantitative easing and fiscal measures during the pandemic led to comparisons with MMT's principles, despite it being a minority view among economists. Many experts warn of potential risks like hyperinflation or unchecked government spending associated with MMT. However, the early stages of the COVID-19 crisis saw concerns about deflation rather than inflation in the U.S., sparking further debate on the applicability and implications of MMT in contemporary economic policy. Despite its contentious nature, MMT has contributed to discussions about the limits and possibilities of monetary and fiscal policy in unprecedented times.